As we get started today, we're going to spend most of our time just kind of debriefing homework 8 and 9. But quick logistics announcement. It was pointed out to me that this upcoming weekend, a couple of religious holidays, it's Easter and Passover, and a lot of people are probably going to be asking for extensions because we have homework due the Monday after this holiday weekend. So I've decided to change homework 10 so that it will be an in-class assignment this coming Wednesday, April the 17th, and that there will be no homework over the upcoming weekend, whether you're just enjoying hopefully better weather or doing something otherwise. Basically, just there won't be a homework due next Monday. I've moved it to an in-class in 2 days. Okay, so that way you can do whatever you need to do over the weekend. Don't have to worry about this class at least, and then come back next week and we'll continue on as we work on, again, group projects are coming up. Yes? You're going to have to finish it by the end of the day. So pretty much yes. All right. I'll give you a hint is that based on what I saw from the earlier sections today, people were kind of struggling with some of the multiple stuff. So I just want to spend more time on it. So we're going to spend more time on multiples. So what I would also say is whatever you basically turned in for homework 8 and 9, and based on what we talked about today, bring that back to class on Wednesday because we're going to continue to work on multiples and evaluations. Okay. All right, so I've updated Elms accordingly. I also posted in the files section of Elms a folder called Homework 8 and 9. And in there are the 2 solutions and then the updated evaluation model that we're going to be discussing in class. So let's go ahead and jump right in. We'll first talk about Homework 8, which was looking at the multiple analysis for Raytheon, General Dynamics, and Northrop Grumman, and we'll start with the price to earnings multiple. Okay? So let's just start with PE, and again, one of the first questions would be, why is Raytheon trading at a premium in its PE ratios to General Dynamics? So using this data, what'd you guys say? Why is Raytheon trading at a premium?
He has the lower cost of equity versus GG. The spread is kind of like in between. It's got like 18.16, then Knox got 27.3 and 14.8. But also it's got a 2% growth.
Yeah.
So the spread plus the growth.
Well, here's the interesting thing. Raytheon's got a little bit better spread than General Dynamics, as you said, but the growth rate is much smaller. It's 2% versus 3.6%.
But the absolute cost of equity is higher.
Exactly. But this is why, and I kind of hinted at this last week where I said it's not just the spread, it's the absolute discount factor. So if a company has a higher discount rate, even if they have the same spread, they're not going to be as valuable. That's exactly what's going on here with General Dynamics. In fact, you could have played around with our model. If you change the cost of equity to be equal to Raytheon's, their multiple would be 30% higher, right? And that's actually what you see in the math. And the reason it's not 30% higher is because there is more uncertainty, higher cost of equity, associated with Raytheon, with General Dynamics than Raytheon. And so that higher growth is being somewhat offset by the much higher discount rate, and that's why General Dynamics is actually trading at a discount to Raytheon. Right? What about Northrop Grumman? Why is Northrop Grumman trading at a discount to Raytheon? Yes, sir.
Much lower expected growth.
Exactly. So it's clear that there's just not a lot of growth in the net income at Northrop Grumman, 0.4% versus 2%, even though Northrop Grumman has a higher spread. And their cost of capitals are much closer. So it's not really a discounting factor. Right? This one should be easy. This one was much more straightforward than the next one we're going to do in terms of the other companies, but hopefully easy. Questions about any of these? Okay. All right, let's go and switch to the enterprise value multiples. So here, Raytheon is trading at a discount, not as a premium to its 2 peers. So on the enterprise value to EBIT multiple, why is Raytheon trading at a discount to General Dynamics? about 10.23 at the time of the valuation versus 12.26. Again, your numbers could vary slightly depending on time of day and which day you did it, but they should be approximate. So what's going on here? Why are they a discount? Yes, sir.
The growth rate higher for
Yeah, the 3.8 versus the 0.2. Okay. And anything else?
the tax rate is lower for Raytheon.
That should be helping Raytheon. It should be helping Raytheon. But I'm saying the WACC is a little higher, General Dynamics, so that the multiple is actually a little lower than it otherwise could be. But nonetheless, I think you hit the nail on the head. The real premium is coming at the much higher growth rate despite its lower spread. Okay? So Raytheon here has a giant spread, but they're not growing it. Right? So the combination of lower spread but faster growth is what makes General Dynamics trade at a premium from a cash flow perspective. Everybody with me on that? Yes.
So you said that a smaller spread but a larger growth, so if the smaller spreads are more like sensitive to growth versus giant spreads?
Correct. And that's, again, generally when you get to a very high spread, and you can see this with Raytheon, when you get to a high spread, growth really matters. Watch what happens when we change this from 1% to 2 to 3 to 4 to 5. And so, again, when you get that big spread, then you really want to find a way to grow it. Now, I'm not saying it's easy, because typically when you get the big spread, it's hard to go find people who are willing to keep paying you more and more money. So unless you're Google or Facebook, until recently, like those are the exception companies. But regardless, it gives us a different insight if we were analyzing these companies in the real world, because if we're trying to understand what's going on at Raytheon, basically what this is telling us, for them, it's finding growth. Whereas at General Dynamics, it actually might be trying to improve their spread, improve their margins a little bit. So just different nature of what's driving these companies. But here's the more important cognitive dissonance question. Here, the Raytheon growth rate is 0.2%. In the PE, it was 2%. Why such discrepancies in growth rates? Because these are both perpetuity growth rates. Yeah.
The one first multiples growth.
All right, and this is growth in. This is growth in ideally free cash flow / no plat, which at constant margins could be revenue. So what do you think this is telling us? What can we learn by the discrepancies in these growth rates? Right? So what is this based on the income statement? What's really driving this? What's driving no plat on the income statement? EBIT, operating income. What's driving this on the income statement? Net income or EPS. That's what's driving it. So let's go to Bloomberg. Let's do RTN US equity. And let's go to EEO. And just to be representative here, and switch to the growth tab. So this is percentage growth into the future. If you look at Raytheon's revenue growth, 6%, 6%, 6 to 7%, 5%, 4%. If you look at Raytheon's EBIT growth, 4, 8, 2, 3. If you look at EPS growth, 14, 13, 12, 13. They're growing their earnings per share much faster than they're growing their operating profits. Why? How do you do that?
Are they buying their own stock?
Exactly. They're doing major stock repurchases. And the market's anticipating that because all these defense stocks, their payout rates are pretty high, and they've been just, they say, investing in themselves, returning cash to shareholders. Well, the point is, it's manipulating their share count. And so EPS growth is very high in that industry. So if you're a shareholder, you like that. But the underlying business, and this is what the market's basically saying, it's not getting better. What you're doing is you're basically replacing, changing capital structure, you're replacing equity with debt. You're basically getting rid of the shares, making it look like the share growth is much better, but the underlying business, and you can see this here in the multiple, the underlying business of Raytheon not getting better. This is the enterprise. This is just the shareholder. And that's why you're seeing a discrepancy between the two. Okay, so that's the point. The share count is changing, and that's allowing the EPS to get up at a higher and higher rate, right? So from a shareholder standpoint, they have a higher multiple. But when you take out the shareholders and just look at the enterprise, the WACC, which is the debt and equity, total investment in the business, they're actually underperforming. And that's what you see. So they're using financial engineering to basically improve their performance in the short term. I don't fault them for doing it. Gives you a higher PE, and it's probably what management's intended to do. But if you actually look at the underlying business, the market's not giving them as much credit. So let's go back. So why is Northrop Grumman trading at a premium to Raytheon? Column B against column D. Why is Northrop Grumman trading at a premium?
They're actually growing their business.
Yeah,
2%.
they're growing. So even though they have a lower spread, both General Dynamics and Northrop have a lower spread. Northrop Grumman is growing at 2%, and Raytheon's growing close to 0.
And also the WACC is like the whole percentage point lower.
And they have a cost of capital of 7.1% versus 8.2%. So Northrop Grumman, even though they have the lower spread, slightly faster growth, lower discount rate. By the way, this is advanced analysis. There are very few undergraduate courses in the world that are doing what you do. Right? People keep this simple. Even in the real world, they keep this simple. What you're doing is learning, because very few people actually try and apply the formulas to understand what's going on in multiples. Right? So you're kind of getting a more of an interpretive view of what you're seeing versus the standard stuff. But nonetheless, should be straightforward using the concepts we've done in the class. Questions about any of this? Yes?
So with RTN, basically the income statement is not changing, you're just spreading among less shares with their repurchase.
If you try and talk about PE versus enterprise value to EBIT, exactly right. That, and by the way, full disclaimer, I've been doing some work recently with Raytheon, and in reviewing the analyst calls and the analyst report, you go to EVT and read this. What the analysts are chirping about is declining margins, right? So take it at a macro level. If you've been paying attention the last few weeks, the U.S. Congress can't agree on a budget with the Trump administration. So right now, what that means is if they can't pass a budget, spending cuts are automatic. Like they're just spending cuts. And so here's the point. Raytheon and all these defense companies get a lot of business from the U.S. government. So if you kind of play that out, they're just not going to grow as fast. They're not going to win as much business. And as a result of that, their margins are under pressure. So translate that into the multiples. The underlying business is going to have a tough time in the next few years. But what Raytheon is doing is to keep buying back stock. And to keep rewarding the shareholders with the cash that they're generating. So the earnings are still growing, but the underlying operating profits of their business is not growing. And that's just kind of macro. Now, that could change. But right now, that's the prevailing view that the multiples are giving us in the marketplace. Right? Make sense to everybody? All right. By the way, the other thing we know is that Raytheon is a higher margin business. That is why people are paying more for their sales, because their margin is almost 17% pre-tax, and everybody else is closer to 12 on the three companies. Now, here's what's interesting. If we know the ROIC and we know the margin, we can solve for the productivity. So one of the other things that we know about Raytheon is more efficient or productive than their peers. They only spend 43 cents in capital to drive $1 of sales, while their peers at 75 or 79. Here's the big difference. General Dynamics, Northrop Grumman are more product companies. Raytheon is more of a service-driven companies. So they're a people business where I think at General Dynamics, Northrop Grumman, they make tanks, they make ships, they build bombers, like basically they make stuff. And with that, higher PP&E, higher levels of investment in inventory than a service business. So Raytheon is, by the nature of their business, getting better returns. Challenge of Raytheon, not the returns, not the productivity. Relative to these three companies, How do you find the next growth vector? Versus the other companies, maybe improving productivity could actually help. All right. So again, you start to get a sense of where the drivers are that the companies can actually focus on that can have the most impact. All right. So this was the straightforward one. Now we're going to go to the one that's a little tougher. Homework 9. Nike, Adidas, Under Armour. We're going to start with PE. And right now, I want you to ignore column D. We're going to come back to column D. Nike, Adidas. Why is Nike trading at a premium in PE multiple to Adidas? You should have gotten a number similar to this. Yes. Okay. The 4.73 versus 386. Okay. And? So similar cost of equity. Yeah, this is an easy explanation. Higher growth, higher spread, same discount rate. Pretty clear why they're trading at a higher PE. Make sense to everybody? All right. EV to EBIT. Anything change? Nike's still trading in a premium here. So they don't flip like Raytheon. Right? They're consistent across the two. Why is Nike trading at a premium in enterprise value to EBIT to Adidas? What can we say? Yeah.
Tax rate.
All right. First, Adidas is paying a lot of taxes. All right. They're paying double the tax rates. That's clearly hurting Adidas. And so let me flip this around. This is another reason why the stock market has been continuing to rise despite some of the challenging things that you see in the headlines. Because when we took the corporate tax rate from 35% to 21%, it basically changes the PEs of the entire S&P 500. All right, you can see it here. If Nike paid 35%, their stock price would be 20 to 30% lower. So what I'm telling you is this is just corporate America. The corporate America is basically seeing their stock prices rise by about 20% and have higher PEs, primarily because they're paying less in taxes. Right? And that's just playing out math. And that is actually the real benefit of the tax cuts that nobody wants to talk about. Everybody talks about, deficits and other things. But the real point is the stock market weren't going up. People wouldn't feel as good about spending money because their asset prices are higher because they're paying less in taxes. And that's the real benefit we've seen of the tax cuts so far. Anyhow, coming back, Nike's trading at a premium because it's lower taxes, higher growth, even though they have lower spread in their business. What's interesting is here on an equity basis, higher spread, but here on an enterprise value basis, lower spread. So again, in a way, similar to Raytheon, Nike has been returning capital to shareholders. It is using more debt in its capital structure. That's why you see a difference between the PE multiple and the enterprise value multiple. In terms of the underlying business, Adidas is more valuable. Okay? Why? Because Adidas only uses 19 cents of capital for every dollar of sales, and Nike is using 55. Right? So just think about that as a reinvestment rate. Okay? So if my competitor is reinvesting 19 cents to drive a dollar sales, and I have to reinvest 55 cents per dollar sales, I'm going to get less free cash flow out of those sales. Right? So what's interesting is that Nike is benefiting in the PE side because it's basically using a lot of cash also to buy back stock and or same time to basically use debt. So it's capital structure that's causing, it's kind of the reverse of what we were talking about with Raytheon. But the point is, that's what's actually happening here. And it's productivity driven. But nonetheless, that's what's key to Nike versus Adidas. Higher growth with Nike, slower spread, similar discount rate, much lower tax rate, leads to the higher multiple. Now, let's talk about Under Armour. Right? Under Armour was going to be more tricky. And before I answer Under Armour, I want to go back and make sure you understand what these multiples are actually based upon. So I'm going to go to the Nike valuation solution that you turned in, something similar to this. And I want you to focus your attention on the valuation tab. And you could pull up any model. You could pull up Yum, you could pull up Starbucks, you could pull up Boeing, you could pull up Nike. It doesn't matter. But any one of our valuation models, you're going to get the same thing. What we're doing arbitrarily this semester is we're forecasting 5 years of free cash flow, year by year, and then we're doing a continuing value or perpetuity. If you look at the total value of Nike, this perpetuity is almost all of the value. And this is pretty representative of the valuations that we will do. 70 to 90% of a company's value, if you do 5 years of DCF, is going to be from year 6 forward. That's the real value of the company. That any discounted cash flow you get in any one individual year of the next 5 years is not going to be too substantial. The real value is that perpetuity period. You can see that right here with Nike. Everybody with me on that? So here's the point. They could have zero earnings period in 2019. Take out $3.2 billion of cash flow. And if we went from 112 to 108, it's not going to really change their stock price all that much. So what matters in our valuation is not the first 5 years, but it's the perpetuity. That key value driver formula, which are the 4 numbers that drive the perpetuity, is the most important part of your valuation. Figuring out the profit, figuring out the long-term growth rate, figuring out the long-term return, and then figuring out the cost of capital. That's what really matters in the valuation, not the individual 5 years. What also matters is the difference between the valuation and the multiples. Is in the valuation, we went out 5 years and then we did a perpetuity in year 6. In multiples, we're just starting valuation with perpetuity in day 1. So the primary difference between the two spreadsheets is the original valuation spreadsheet starts this in year 6. In multiples, we don't do year by year. We just start our valuation as of today. So in the multiple spreadsheet, these numbers, these 4 numbers, drive the entire value of the company, period. There's nothing else. So I got a lot of emails this weekend, and I sent very short replies, which some of you probably thought, well, gee, that wasn't very helpful, even though I was actually being truthful, which they said, what numbers should we put in here if we change it? And I kept replying, put in what is representative, right? And here's what I mean. I'm not being flip. This is actually true. Because what I want in all 4 of these numbers is I want the representative tax rate long-term. I want the representative growth long-term. I want the representative return long-term, and I want the representative WACC long-term. Because those are the only 4 numbers that are in my valuation. If the short-term does not look like the long-term, then I'm going to have a problem. Because if the long-term looks far different than the short-term, and I put my short-term numbers in, and I plug them into a perpetuity formula, the answer is not going to look the same as if my long-term numbers were put in that look different. That is what's going on with Under Armour. Because if you think about it, where are you getting the data? For operating ROIC, you're using the current one. And we're saying the current operating ROIC equals the perpetuity one. The growth rate, current growth rate equals future growth rate. Okay? Those are the 2 ones that matter the most. So here's the point. When we did Raytheon, General Dynamics, Northrop Grumman, these are pretty mature defense and aerospace companies that in 5 or 10 years are going to look a lot like they do today. Not much is going to change in that business. I intentionally picked that industry for you to do the multiple analysis because I knew that the future was not far different than the past. Is that the case with Under Armour? And so what I want to do is I want to show you, just very quickly, if I go back to Under Armour, little history here, FA, and if I look at these ratios, look at ratios and look at profitability and just focus on either EBITDA margin or operating margin in the last 6 years. Notice an interesting trend about that? What kind of trend line do you have in their profit margins? Yeah, it looks like JCPenney's. Looks like they're heading out of business. Is Under Armour a going out of business company? That's what we're valuing them as. We do the multiple analysis. We're valuing Under Armour with a negative spread. They have a negative spread right now, and the next 2 to 3 years are going to maintain a negative spread. Right? But the PE is crazy. PE is over 30. Negative spread companies don't have PEs of 30. That's what the academic formula says. So what is the market implicitly saying about Under Armour if its PE is 30? Long term, representative. That they're going to fix the business long term outside of the first 3 years, and that spread's got to eventually turn positive. Now I'm going to give you the math reason first. Number one, in a perpetuity, G cannot be greater than your WACC. That's flawed math. So I had people in an earlier section say, I just made my G 15%. Well, you can't have a G higher than your WACC. It just doesn't make sense. So that's not a reason. Another person put a negative G. Well, you're basically saying that Under Armour with a negative G is going to have even worse earnings growth and cash flow growth in the future. That's the going out of business model. I don't think that's going to happen to Under Armour. I mean, maybe. It's possible, but that's probably unlikely. So the more likely scenario is Under Armour is not going to go crashing into the ground, that they're going to pull up and they're going to go back to doing reasonably well. So it also involves, which we didn't do in EIC, understanding what happened to Under Armour 2 to 3 years ago. So 2 to 3 years ago, Under Armour completely effed it up. Right? Now, again, Kevin Plank, he is a Maryland grad. He's a graduate of the school. Gives lots of money. Today he's giving less. Right? Hires a lot of students. Today they're hiring less. They're laying off people and cutting costs. They were going to build $1 billion campus in downtown Baltimore to help transform the city. They put that on the shelf because they screwed the company up so badly in the short term. What mistake did they make? It was very painful for them. What was the big thing they did about 3 years ago? Anybody know? And I'll give you a hint. They spent $25 million to have a celebrity endorse a new product launch. Who's the celebrity and what did they endorse? Anybody remember? Yeah.
I don't know the celebrity, but it was like in New Jersey or something like that.
Wasn't New Jersey. It was a guy who plays for the Golden State Warriors. It was Steph Curry. And what was Steph Curry paid $25 million to endorse? Shoes. That Under Armour was trying to get past apparel into the shoe business as part of the athleisure growth. And they were going to make a big run into the shoe business, which means they were going to compete with Nike and Adidas. And so they hired Steph Curry as their spokesperson. They put a lot of money in tech to have these great shoes that nobody bought. So the year after they launched this, top 10 shoes, Nike had number 1 through 9 in sales, and Adidas had one of the top 10 spots. Under Armour wasn't anywhere near the top 10 in global sales for shoes. Nobody bought them. Actually, it's funny. One of the students in one of the earlier sections said that he bought them. He felt kind of sheepishly admitted he bought the overpriced shoes. And then I say overpriced because they ended a quarter with a few $100 million of unsold Steph Curry shoes. And then they liquidated them at 40 to 60% discounts. So they basically gave them away. And nobody wanted them. And it put a huge cloud over their entire brand because suddenly Under Armour was no longer the superstar. They went from growing double digits to not growing at all. The products that they were launching, nobody was buying, and people started questioning them. And that put them through a very tough couple of years. That's the negative margins that you see on that page. It's exactly what happened is when they got crushed going into the shoe business. So here's the thing. Do you think Under Armour is a damaged brand beyond repair? Anybody wear Under Armour clothes? Are you not buying Under Armour clothes because they had faulty shoes? Are you not buying Nike clothes because Zion Williamson almost killed his career with a Nike shoe? So here's the point. Are they going to get past it? Let me ask you a question a different way. Do you think the market believes that they're going to get past it? Well, that's what this multiple tells me. So what the market is telling me is the only way that we can justify 30 times EBIT is if this spread turns positive. So the secret to the Under Armour answer for this assignment is you had to basically flip the spread. Because we can't use last year's or the current spread to represent perpetuity because only way we can explain the actual valuation is that the market believes that Under Armour is going to do pretty well in the future. And if you think about it on a macro level, athleisure continues to boom. I mean, I can't remember the last time I wore a coat and tie. I mean, seriously, nobody does anymore, except for you guys in interviews. I'm not saying don't do it there, but I'm serious. Like, it's a business casual world. People are getting more casual all the time. And companies like Lululemon are just kicking ass. Nike is getting into this business. You know, basically, Under Armour is in this business, and they're getting past sports and all these other things. And so that's the point. People think that, yeah, they've learned from their mistakes. They're going to fix their problems. They're going to figure it out. And they're in such a good market that's forgiving, and they're priced accordingly. So this gets to the art of valuation. I can't tell you what the spread's going to be because the market isn't telling me what the spread is because it's a spread growth combination. I just know you had to make it positive in order to do this. So here's the next question. How do we figure out what kind of spreads we could use for companies that aren't at scale today that will eventually be at scale and mature? And the answer is we use comps. Translation. What's Nike's spread? What I did is I said, I personally believe that Nike is the better company between Nike and Under Armour. I think Under Armour's good. I think Nike's great. So I put their ROIC a little bit lower than Nike. You might have a different opinion. You might believe Under Armour is going to be better than Nike long term. You could have had a slightly higher spread than Nike, but it's probably going to be somewhere in that ballpark. Right? I don't think it's going to be as high as Adidas, but the point is, if you put in that spread, you're going to get a growth rate much higher than Nike or Adidas. And by the way, it makes sense logically. If my earnings are half yours and I catch up to industry average, going from 0.5 to 1 is a pretty good CAGR. And that's what you're seeing with the high Gs. So the high Gs for Under Armour have more to do with going from below average to average than outperforming the industry long term. And if they can actually do well long term and get back to average, then that gets them a much higher growth rate because this is the growth in the earnings and cash flows. So the G for Under Armour is much higher, right? And that's what the positive spread suggests. So the real answer to this assignment was you had to flip the spread and then come up with a high positive spread and some G that explains it. And it's not the combination. Like, I can't tell you exactly what the spread had to be other than it had to be positive and the G had to be positive. And that's what you would have had to do on this assignment. Yes?
So if we got the expected ROIC,
You could have played this out in the valuation as well to do the as is. But unfortunately, what I heard a couple of students tell me this morning is when they did that, they were getting single-digit ROICs to do the as is. Now, again, I didn't really look at their models yet. This is just what they verbally said. But I'm telling you, single-digit ROICs are going to get you negative spreads, and therefore they're not going to get you to this valuation.
I got a pretty high expected ROIC.
Then you probably did it at a more realistic way. So what ROIC did you get in the out years in your model?
39.
So you're closer to Adidas, which means this G was probably what, 7%? 8? Exactly. And I can't tell you that this number is better than your number, but I think the insight you did, and your as is better than what people were doing earlier, is that you basically said the same thing I'm telling you, which is in order to justify the price, that spread eventually long-term had to turn positive. And that's what's key to the insight in this valuation. Questions? This was hard. I don't, in retrospect, I'm making it sound easy, but if you've never kind of experienced this before, it's hard to explain. That's why people in the real world will dismiss this as an anomaly. Like, oh, you just can't explain everything. Yes, you have to explain everything. And when you really think it through, this is actually very explainable. All right, questions about this? Okay, so here's the next piece. You had to then do an as-is valuation of Nike. So here's an approximate one. And when you did your as-is, the one thing I added, and I did this in row 24 of the ratios, could put it in different places, but I did the historical invested capital divided by sales ratio. Because when we look at productivity, this number or this row of numbers, is basically this number. So here's the other thing we know about Nike. That Nike is spending 55 cents per dollar on a reinvestment or investment in their business to grow sales. And Adidas is spending 19 cents per dollar of sales, and Under Armour is spending 24. That's what the multiples tell us. Right? So Nike is spending, I'll just round off, twice as much to generate a dollar of sales as Under Armour and Adidas. So here's the point. This leads to free cash flow. If I have twice the reinvestment of you, I'm going to have lower free cash flow because I have more gross investment. Right? So here is the potential flaw in the as-is valuation we did of Yum, which I want to come back to, but I want to talk about with Nike. Look at what Nike's historical levels of investment are. And by the way, we know going forward it has to be this number, because if Nike has this ROIC and Nike has this margin, and you can even see it in our model. Where is it here? Nike valuation. In terms of the ROIC drivers. This times 1 over this is that. So we know this is margin, this is productivity. This is margin, this is productivity. This times 1 over this is that. So this is the invested capital sales ratio. This is the 0.27 for 2014. This is the same 0.27 in 2014. So Nike had historically spent 29, 27, 25, 27, 29, 27, and in our valuation, 27 in the out years, because this is the as is. If the balance sheet is just growing at the same rate, they're going to keep spending 27 cents per dollar on capital. But here's what the multiples tell us. In perpetuity, it's going to be 55. So in English, what does that mean? What's the translation? When we go from 27 to 55, what is the market basically saying? Why would their productivity decline? Anybody know how Nike defines themselves? Yeah. Exactly. Anybody know how Nike's defining themselves today? They're not just defining themselves as a shoe or an apparel company. They're defining themselves as a technology company. As they get into 3D printed shoes, as they get into clothing that interacts with the environment around them, as they get into all the designs that they're putting into the clothing and engineering, they're putting a lot more tech into this stuff. And oh, by the way, they're no longer exploiting child labor in Southeast Asia. So they're moving manufacturing to higher cost countries. They're doing more robotics. At the same time, they're paying more labor costs. So what the market's saying is Nike is probably going to have to spend a lot more money to do sales in the future. So that's why they're upping their reinvestment rate. So the Nike of the past, it's not about changing the margins. It's about doubling the I. Well, here's the point. If I have more reinvestment, same profit, I have less free cash flow. So when you did the as-is valuation, if you left this at 0.27 and you didn't change the balance sheet, in order to get a share price that matched, you had to come here to growth rates and make these growth rates very negative. And if you think about it conceptually, Nike's probably not going to shrink dramatically in the next 5 years, but it would have to make the math work. And so what I'm saying is we need to flip this around as the exception, is that Nike is not slowing down its gross cash flow. It's not slowing down its growth. It's not slowing down its margins. The problem with Nike is it's hurting its free cash flow / valuation because it's putting more of that back into the business. So that's what the market is expecting. So when you actually do this, yes, growth is slowing, but we're talking about low single digits, not negative growth rates. And that's the nuance in the valuation. And by the way, you could have ramped this up over time because this is the perpetuity period, but it's the same thing as when we did the EBIT margin in perpetuity. So it's just another data point that helps us start to understand what the market is thinking. Now, to be clear, this is the as-is valuation. So you could have done this with your target, if you did one, and disagree with what the market says. You could say, I think the market's got it wrong, and that Nike's value is going to basically stay higher because they're going to keep more of the free cash flow. And oh, by the way, if they do this, if the investment rate stays the same, they're worth $100. So basically, by using the market valuation, the market is chopping off about $11 a share, $11, $12 a share by saying they have to reinvest more. And again, it's not a question of whether the market's right or wrong. That's what the as is telling us. Again, advanced topics, but any questions about this? Yes?
In this class, will it matter where we put the changes in this?
No, because practically all of this leads to the investment rate. So I very simplistically in the last section just put it all in net fixed assets. But practically, it's probably a combination of more inventory, more receivables, and net PP&E, more big IT systems and or plants they're going to have to build. But the model doesn't care from a cash flow standpoint. Same thing. I probably would have just, instead of going off a cliff here and just jumping up dramatically, I'd probably step it up over time. But I go back to, let me make this, watch what happens when I make this 40% into year 2. Stock price barely moves. It does move. But what matters more is the perpetuity period. Because if I go 40 and then 12.2, then the stock price doesn't change. So the year-by-year forecast is less important than the perpetuity forecast for the same reason I showed you that valuation tab. Now, if it went to 40 and then stayed 40, then these years would matter, but that's the point. If it's just 40, one-time blip, and then this is the one that matters. So that's what I said. I'd step up these years, but for all intents and purposes, this is the more important one to solve for when we're doing the as-is. And I'm not saying it's exact. Like I said, these are kind of swags, but what we're doing is we're using the academic formulas to back out some numbers. So as we said, rather than just saying, let me throw some numbers at G, let me throw some margin numbers, some sales growth numbers, taking a little bit more of a methodical academic approach to get us started. Then you can start swagging it. But this is the way I want you to start doing it, including for your group projects coming up. Questions? So as I said, we're going to do another assignment similar to this on Wednesday. All right, but before we do, I want to answer one last question before we wrap up today. I want you to take out the YUM valuation model that you submitted. Right? And I'd like you to very quickly do a YUM multiples analysis to figure out YUM's productivity based on today's multiples. When we debriefed YUM, one of the trends, I go back to YUM, that I had showed you about YUM brands and we saw this under FA when we looked at segments, is that YUM, when we looked at by segment, was getting rid of company-owned locations in favor of more franchises. And my question, which was a little bit more rhetorical, was after we did the valuation of YUM, were they done? Were they done selling off their company-owned stores, or were they going to push more franchising? All right. At the time of the valuation, we weren't worried about it, and so implicitly, we assumed that they were done franchising relative to franchise and store owned. What does the multiple say? What does the multiple say about YUM, the multiple analysis, relative to our valuation to answer that question? So is the market predicting that YUM is going to continue to franchise more stores and get rid of company-owned stores? Or does the market feel that this is the appropriate mix going forward? So we have an as-is valuation. We have an IC to sales. You have a YUM. You don't have to do its competitors. A YUM quickly productivity based on its multiples. Let's just see if we can figure out whether or not YUM is going to continue to franchise. Give you about 5 or 10 minutes, and then we'll answer that question.